All right, let's dive right in. We all get excited watching our investments grow, right? But here's the thing. Making a profit is really only half the battle. The other, arguably more important half, is actually keeping it. And the key to doing that is understanding something a lot of people try to ignore: taxes. So, we're going to get into this because learning these rules is how you really truly start building wealth.
So let's just start with a really simple question. Imagine you made a 20% gain on a stock or crypto or a real estate deal. That feels amazing. But is that the amount that actually hits your bank account? Spoiler alert, it's not even close. The real question is, after the government takes its slice of the pie, what's actually left for you? That's exactly what we're going to figure out today. So here's our game plan. First, we're going to cover the two basic ways your investments make you money. Then we'll get into the super important idea of tax timelines, and I'll show you a case study that proves why patience pays off big time. After that, we'll unlock some of the tax secrets of real estate, navigate the wild west of crypto, and finally, we'll tie it all together so you can build your own tax strategy. Okay, section 1. Gains versus cash flow. Look, before we can even think about talking about taxes, we have to get crystal clear on the two different ways our assets actually put money in our pockets. It seems like a simple difference, but trust me, it's the foundation for everything else we're going to talk about. So what's the deal? Well, capital gains are all about growth. It's the classic buy low, sell high. Think about flipping a house. You don't make the real money until you actually sell the thing. That profit you make, that's a capital gain, and it directly bumps up your net worth. Cash flow, on the other hand, is income. It's the rent check that shows up in your mailbox every single month, or the dividend a company pays you just for being a shareholder. It's the money that you get on a regular basis while you still own the asset. Okay, so that brings us right to section 2. This is where we get to the real meat of investment tax strategy, the two tax timelines. You have to understand that the tax code isn't just a random set of rules, it's designed to encourage certain behaviors. And one of the biggest things the government wants to encourage is long-term, stable investment. Basically, it wants to reward your patience. So let's define our terms. What is a capital gains tax? It's really simple. It's the tax you pay on the profit you make when you sell something. But here's the kicker, the part that changes the entire game. The tax rate you pay is completely different depending on how long you owned that asset. And here are the two timelines, side by side. If you own an asset for 1 year or less, that's a short-term capital gain, and it gets taxed at your regular income tax rate, the same high rate you pay on your salary, which can be up to 37% in the US. But, and this is a huge but, if you hold that exact same asset for just 1 day more than a year, it magically becomes a long-term capital gain. And boom, the tax rates plummet to 0%, 15%, or 20%. The difference is just massive. It's a clear signal to invest for the long haul, not just flip for a quick buck. So you're probably thinking, okay, how much of a difference does this really make? Is it just a few percentage points? Well, let's look at a case study over 20 years that shows the truly staggering cost of impatience. This isn't just a small difference. It's the kind of difference that can change your entire financial future. I just love this quote because it's so visual. Think of those high short-term tax rates like acid. Every single time you sell too early, you're pouring that acid all over your profits, and it just eats them away before they ever get a chance to grow and compound. Okay, let's break this down because it's so powerful. We've got two investors, A and B. Both start with 50 grand, and both are great investors, earning a solid 10% a year. The only difference is their strategy. Investor A buys and holds for 20 years. They just let it ride, only paying one tax bill at the very end. Investor B, the trader, sells every year to lock in that 10% gain, and every year they get hit with that high short-term tax bill. So every single year, Investor B starts with a smaller pot of money to reinvest. That asset is constantly eating away at their principal, killing the magic of compounding. And here it is, the final result. After 20 years, Investor A walks away with over $114,000 more than Investor B. Let that sink in. They didn't pick better stocks. They weren't a smarter investor. They simply understood the game and the insane power of tax deferral. This is the whole secret behind Warren Buffett's strategy. The cost of impatience is literally written right here in dollars and cents. Okay, so we've established that holding long-term is huge. But what if I told you that there's an entire asset class that has even more powerful, built-in tax advantages? Well, let's jump into Section 4 and talk about real estate and its investor superpowers. The biggest superpower here is something called depreciation. Now, stay with me. The government lets you deduct a property's wear and tear over time, even if the property is actually going up in value. This creates a paper loss, which you can use to cancel out the real cash income you're getting from rent. The result is what investors call phantom income. You're getting real money in your pocket, but on your tax return, it looks like you have a loss. And here's the best part. You get to depreciate the entire value of the building, including the part you borrowed from the bank, not just your little down payment. It's an incredible leveraged deduction. And then you've got the holy grail, the 1031 exchange. This lets you sell a property, take all those profits, and roll them into a bigger, better property without paying a single penny in capital gains tax. But you have to follow the rules to the letter. You can't touch the money. It has to go through a neutral third party. And the timelines are no joke. You have exactly 45 days to identify your new properties and 180 days to close. Miss a deadline by even one day, and poof, the entire tax break is gone. All right, let's pivot from brick and mortar to the blockchain. We're moving from the old world of real estate to the brand new frontier of crypto. Now, crypto taxes can feel like a minefield, for sure, but there are also some pretty unique rules and opportunities if you know where to look.
Now, this is fascinating. In the stock market, there's something called the wash sale rule. It stops you from selling a stock at a loss for a tax break and then immediately buying it back. You have to wait 30 days. But here's the thing. Right now, in the US, that rule does not apply to crypto. So you could theoretically sell your crypto at a loss, use that loss to offset other gains and lower your tax bill, and then buy it right back a minute later. It's a powerful strategy called tax loss harvesting, and it's a loophole that's unique to the crypto world for now.
And these rules are completely different depending on where you live. The US has the same short-term and long-term rules we've been talking about. But check out Germany. If you hold your crypto for more than 1 year, the sale is 100% tax-free. That's a massive difference. But here's the main takeaway for everyone, no matter where you are. The days of crypto flying under the radar are over. New global reporting rules mean that by 2026, your crypto data is going to be automatically shared with tax agencies. You absolutely have to report it correctly. Okay, we're in the home stretch. We've learned the rules of the game. Now, how do we actually put this stuff into practice? It all comes down to building the right structure for your investments and, just as crucial, getting the right team of people on your side. You know, probably the single most important piece of advice from all our research is this. Investing is not a solo sport. The tax code is insanely complex, and it changes all the time. When you decide to get serious about this, your first hire shouldn't be a stock-picking guru. It should be a professional CPA or an accountant who really gets investors. They are the absolute cornerstone of your team. And one of the first conversations you'll have with them is about structure. For holding something like real estate, an LLC is almost always the way to go. The profits just flow through to you, and you get taxed on them once. Simple. But putting that same real estate inside a C corporation is, and I'm quoting here, a disaster. Why? It's something called double taxation. The corporation pays tax on the profit, and then when it distributes that money to you, you get taxed on it again. It is a fantastic way to destroy your wealth. And this chart just shows you how costly that one mistake can be. On a $500,000 gain, choosing a C Corp instead of an LLC would cost you an extra $144,500 in federal taxes alone. That's not a rounding error. That is a life-changing amount of money that you're just giving away because of the wrong legal paperwork. So let's just be really clear about the big picture here. This isn't about finding shady loopholes or trying to illegally avoid paying taxes. Not at all. It's about understanding that the tax code is basically a rule book full of incentives. The government actually wants you to invest for the long term, to provide housing, to build businesses. Being a smart investor is simply about understanding those incentives and legally playing the game by the rules as they've been written. We have covered a ton of ground today, from the simple difference between short and long-term holds to the complex strategies in real estate and crypto. Having this knowledge is incredibly powerful, but, it's really only the first step. So the real question I want to leave you with is this. Now that you know the rules of the game, how are you going to play it differently?